All right, everybody, thanks a lot for joining me on this Wednesday afternoon market recap. Approximately 20 minutes left in today's session. However, we are really starting to develop the narrative around what has become that of very important support across the board collectively for these markets. So what I'm going to do is give you essentially a playbook of what to look for moving forward. I do believe we are going to see one final sell-off, which is ultimately going to close the gap between yesterday's price action, where we closed yesterday, and today's gap prior to establishing that of the true foundational support upon which we are going to base ourselves off moving forward. But the good news for macro market participants on the bull side is that we are holding this support. It was appearing as though on Monday we were going to definitively push back down, all the way down to the 2018 calendar year lows. That wasn't the case. On Tuesday, essentially the handbrake was pulled. We had a very nice tweezer bottom candle. And then today, during today's session, or at least on the open, we had a very nice gap up, and then more or less a continuation throughout the entirety of Wednesday's session. This is not only applicable to the Dow Jones Industrial Average, it's also set up this way again on the S&P 500. Again, a very nice tweezer bottom between Monday and Tuesday, and then a gap out between Tuesday and Wednesday. At the moment, with approximately 20 minutes left, it looks as though we have a shaved top, a flat Morobozu long day candlestick. Again, no lower wick with that, pardon me, of very little or minor up wick at this particular point. Very strong candlestick continuation signal. And then to show you the same or a similar type of pattern on the NASDAQ, it isn't as well defined when it comes to the tweezer bottom, but we certainly have that gap between the close yesterday and then, of course, today's trading action. So if I go back into, let's switch it up and have a look at the S&P 500. This is really what you want to look for moving forward. I've had a lot of emails come in suggesting that, at least asking anyway, are we at the bottom? And in my opinion, yes, we are towards or very close to the end of this sell wave. We've had the first sell, followed by the secondary sell side wave. The secondary sell side wave is the one that we were talking about, really exhausting and just allowing it to exhaust itself. It appears as though that exhaustion has more or less run its course. It established itself on Monday with this long lower wick over here, a big day of indecision in the market. I think it was about a 900-point turnaround in the Dow Jones Industrial Average, which then set up that inside day tweezer bottom candlestick on Tuesday, which we have begun to continue out of during today's session. So this is really what I'm looking for when it comes to a true base and how I'm going to play it moving forward. So obviously it looks as though momentum, or at least direction, is shifting. The problem is that we have this open window. Now, if you've been with me long enough, you understand just how significant open windows are. The reason they're significant is because generally they need to close prior to the next, story, right, or narrative of the market moving forward. The dynamic switching between that of a sell side move, intermediate sort of correction move, and that of the continuation of the larger primary bullish uptrend. So when we look at this, although we have seen again the S&P 500 closing up 53 points, or at least moving into the close 53 points positive, Dow Jones is up over 400 points. What you have to think about is, well, on the short-term outlook of this market, these gains that we have established during Wednesday's session, they are ultimately short-term going to be given back. And the reason I say that is because although we can suggest that, we can say that, look, well, the Dow should sell off potentially another 400, 500 points to actually close its open window. Once we get down to this area, which is coinciding again, roughly, more or less right in the middle of our target at 25 and 24,750, this is going to be, all right, potentially that bottom. And the good news is that over the past week or so, we've actually been pricing in the structure that we've been needing to see for a foundational base to actually work. So moving forward, we only have 2 sessions left in this week, upcoming, obviously. Tomorrow, of course, being the first day of earnings, and tomorrow the big market mover is going to be Apple's earnings. So depending on how the market reacts to that, and also probably over the next couple of days, if and when we see this market pulling back down to 24,750, or at least to close this open window, the first candlestick you see that sets up a reversal candle to the upside, all right, depending on what that candlestick is, that's going to be the best opportunity to actually enter into the market long on long side, or at least call side option trades if you want to take advantage of the diamonds, the SPYs, the Qs, or of course you can jump into individual stocks as well based on that individual analysis. But before or instead of simply jumping long into the market at the moment at these elevated prices, right, at 25,500, if you simply just wait for the market to pull on back down and to close the window down here close to the 24,750, you're going to get most of all a much nicer risk and reward ratio. So when it comes to emails as well, a lot of people asking about the base. I've also had sort of a secondary flow of emails asking about, well, why not short the market if you're confident about it going lower? And the reason for that is because simply reward risk ratios. And we spoke about this over the weekend in Pro, and we're just looking at the dynamic of, well, what is the actual reward to risk on actually taking a short down around these areas? And really it was quite confronting, where the actual ratio itself was really unjustified, or it didn't really justify that of the trend moving forward. So instead of thinking through the prism of a bearish outlook, even though we have entered more or less up here closer to the top of the market, 26,203 was where we began to see the cracks in the market, and really which has ushered in that of the intermediate correction. What we've been waiting for, at least talking about, is waiting for this to, for the foundation to set up upon which we have enough evidence to go long. And really that evidence is coming from today's session. And of course the candlestick, which did set up yesterday during Tuesday's session of trade. Tweezer bottom, a gap out. The gap out needs to be filled. This rally could sort of, continue into Thursday, could continue into Friday, but ultimately it's going to come on back down to roughly 24,750. When we get down to 24,750, that is going to be when we look for bullish candlesticks upon which we are going to bring down entries to take advantage of the macro bull trend continuation. This process here, I'm unsure, honestly, how long this will play out. It may only be a couple of days. It may be closer to a couple of weeks, but at least we've got the structure upon which we can base a reliable trading plan moving forward, and a really good sort of actionable series of what ifs, right, moving forward when we see what I'm talking about essentially right now. Now again, I'm going to go into the S&P 500. This is coming in closer to roughly 2,675. We can continue for a day or two. We can continue for a week higher. But ultimately, we're going to come on back down, close this open window prior to seeing the major macro bullish trend continue. So if you have the patience, wait for it down here. If not, you can jump in at higher prices. But understand, if you do that, there's a good chance that those positions are going to reflect a negative, all right, return, or at least sort of an unsettled loss, all right, a paper loss, for a little bit until we see that definitive move higher. And what's most likely going to happen is that we're going to set up a resistance area upon which it's going to become the breakout at a later date once we clear it. So look for something like this collectively across the board on the markets. And really, that's the way to be playing it. The good news also for the NASDAQ at the moment is that we're back above this accelerated, right, fan line off from the macro bullish trend, which you can see in this purple line on my screen over here. So we're still holding up above it. We got down below it temporarily, but as you can see, we've got the rally out of this support area, again around 7,050. Didn't get all the way down to 6,910. This was ultimately my second target down here. Got very close to it. This was on Monday's session. This is where we saw the big intra-session volatility spike. But really, since Tuesday onwards, it looks as though we are essentially in that support area upon which we're looking for this market to move higher. But first of all, we have to close the window. The window is coming in at about 7,150 on the NASDAQ as well. So that's going to lay the platform, all right, for the market, which is also going to flow into our top 12 individual trade list. But I needed to give you this update today because we have the first signal, right, mixed with the tweezer bottom on the other two markets, that is signifying to us that we are towards the end of the secondary sell wave exhaustion that we were speaking about over the past week to 2 weeks. And this is all happening as planned, really, as we've expected. When we came up here and we started to see the ADX turn down, the CCI crack below that positive 100 reading, then we started to see, of course, these dark candlesticks ushering in what has been a pretty bearish month for the month of October, all right, or a very bearish month in the month of October. Now, again, Apple reports tomorrow, so that's going to be most likely a market mover. The good news also is that we spoke about Amazon down to 1,500. What's happened? We hit it. We're starting to see the bounce. Good news is that with these gaps to the upside, they're also setting up on the individual stocks as well. So you can see here, we've got the gap out between Tuesday and Wednesday. You can see the pattern already setting up on these individual stocks. So I wouldn't be jumping out or at least racing out to buy them at the moment. What you'll need to do is to reevaluate these trades once the market indices come back on down to close those open windows, and then we can formulate, of course, tighter entries into these individual stocks. Boeing Airlines largely unchanged since earnings. However, it has been a rather volatile period for Boeing Airlines, much like a bunch of other individual stocks. The good news, by the way, is that Baidu did report earnings, and this is something we were hoping for, really, on Baidu. Baidu was really testing its trend line going back all the way, to 2009, And we were just hoping that it wouldn't gap below this rising trend area. So you can see for yourself just here, we've held it. If I remove this vertical line on my screen, you can see that really it appears to be setting up that of a Morningstar 3-day reversal candlestick pattern. So the one outlier of this, really at the moment, would be Baidu being a definitive entry. The problem is that we have Apple reporting tomorrow, and that could actually be a market mover. Plus, you've got the markets themselves coming back down to fill that gap. So I wouldn't be jumping into Baidu immediately. I'd simply correlate the Baidu entry with the SPY, with the diamonds, and with the Qs, or even just the market indices themselves. Once they come on back down and close those windows, we'll reevaluate Baidu then, and we'll be placing entries on that individual stock as well. Good news for Caterpillar is that we're starting to set up that of a rounding bottom. I'll speak about more about that over in Saturday's analysis class. We've got COP holding at $64 per share. It's closed the window as well. So again, you can see a lot of these stocks printing in bases, or what may even become double bottoms if we see the rally, the pullback, and then of course the break above the swing highs. I'm just illustrating it for you right now. CVX is set to report on Friday, so there's no trade set up on that individual stock. We've got Google as well. Right, this is something that we've also been wanting to pay close attention to. Right, it's held at 1,000, which is really good, and this goes all the way back. If I can zoom out and show you this, it goes all the way back to the calendar years of 2018. So this really right now is a long-term consolidation. It's really a flush out of a lot of the weak longs and the overly aggressive shorts. I think we've based on most of these tech companies, and it's also coinciding at psychological round numbers as well. So I wouldn't be gravitating immediately into Google. Look what we have here. Surprise, surprise, an overlap. We have another gap, which will fizzle, which will fill, and that is most likely going to set up some form of a short-term double bottom. Ideally, though, it's not at the right location, but we can call it a double bottom just for sort of the trend continuation standpoint. But that's really what you're looking for. You shouldn't be racing out to jump into these stocks, even as at the close on Wednesday. We've got IBM, which is still holding below this trend line. So unlike Baidu, if I zoom out and show you this, Baidu's been in a trend since 2009. If you have a look at IBM, this goes all the way back to 1993. Now, obviously, it has been absolutely clobbered. It's probably paid overs for Red Hat, and it's still really not finding any form of a support, even with the market rallying over the past 2 days. Okay, IBM is continuing to sell off, but what we can do is actually overshoot some of these trend lines, especially when we're evaluating, or at least looking at trends going all the way back to 1993. You have to allow a little bit of leeway. So I wouldn't be looking to just jump into IBM short at the moment, not with the market potentially basing. I'd allow this a little bit more time, potentially to set up some lower wicks, which is going to whipsaw a lot of overly aggressive shorts. And then you could, expect, or at least look out for a couple of candlesticks, engulfing candlesticks, tweezer bottoms that we set up yesterday on the market indices, which is could, or very well could, propel us back up to 140.45 on IBM. So think about that as well. But at the moment, again, I wouldn't be rushing out to jump into IBM. Similar type of setup on Netflix, another little gap between Tuesday and Wednesday. This is probably going to be the support base at 275, which is good. Too early to jump into it at the moment. There's no foundation, there's no structure. But again, if we get that secondary pullback, that will start to mark that of the structure being the upper resistance, short-term resistance, and that sort of double bottom support that I'm proposing to you in this Wednesday afternoon market analysis. The final stock here is Tesla. Tesla continues to rally after earnings. It's come up, it's closed a lot of these open windows, but really right now we're in no man's land. We're right between macro support down here at 260 and also resistance up here at $380. So we have better candidates for individual trades, let alone the market indices if you wanted to jump into some directional trades on the SPYs, the diamonds, or the Qs as well. So I hope that makes sense, everyone. If you have any questions, please email me. All right. Other than that, I'll see you on Saturday in that next pro analysis class. All the best, everyone. Farewell.